Hello, welcome back again, and this time we're going to look at the statement of financial position. So we've looked at some of the statements in general terms. This time we're going to look a bit more specifically at what's in the statement of financial position. So after reading the book and watching this lecture, you should be able to understand the structure and content of the statement of financial position. Some of the major characteristics: obviously, for assets, you've got to have a future benefit that we mentioned. The business must have the right to control the asset. The benefit must arise from some past transaction or event, and the asset must be capable of measurement. Obviously, they can be split into short-term, current assets of 1 year, and longer-term, more than 1 year. So let's go back to Stanley Gibbons' statement and have a look and see where the assets are there. Well, we've got non-current assets, current assets, then we've got the other areas. But for the assets initially, we've got the long-term or non-current assets. And again, you can see for Stanley Gibbons that they've got the normal type of items there. They've got some property. They've got land, obviously, as well with the property. But they've also got other areas as well that are regarded as longer term. And they've got a reference collection, which is a collection of all their stamps that they've got. And that's been put into a particular type of investment these days. So that's held as an asset. These are actually worth a lot of money. Now, it's not a current asset because it's held in the longer term. So again, hopefully the price of the stamps will go up and the people who invest in that will make money from it. But Stanley Gibbons are holding these stamps either to sell themselves in some cases, but mostly for investors. So you can see that this actually makes up a lot of the value of most companies, the non-current assets. We've got the current assets next, and for most companies they've got some inventory, some stock. They've got some people who owe them money, trade debtors or trade receivables. They've got some cash or bank, and these tend to be the main items that people have in the current assets part of their accounts. Obviously, current assets are important because unlike the non-current assets, these are often the part where you're actually trading these quite quickly to create more turnover or to sell more items. The more money you tend to put into the current assets, the more profit that you'll have, or at least the higher your turnover will be, and hopefully the greater the profit will be. Whereas the fixed or the non-current type assets, these assets tend to be there for a long period of time, and if you buy new ones, they maybe become more efficient from the business point of view, but they don't have a dramatic effect on turnover. The current assets will often have quite a dramatic effect. Obviously, some companies are trying to reduce their current assets as much as possible. People like supermarkets, for example, tend to try and reduce the current assets as much as they can, because a lot of them actually have banking arms and they can put the money in the bank and make it work there as well for them. There are essentially two types of claim against the business that we covered before. So these are equity, which are the shareholders and the money that they've got invested in the business, and they've got the liabilities. And the liabilities again are split into short-term type liabilities, current liabilities, and long-term liabilities, so non-current liabilities. These tend to be loans or debentures, sometimes they're called, that the company have taken out to raise money. And again, our accounting equation, how that works. So we've looked at this already, but it's quite useful now to put it into the context of your financial position. You can see at the top, you've got your assets, then you've got your equity, and you've got your profit that you've made. So from the income statement that we looked at previously, this profit will come into the equity part. So that will come in as profits that have been kept on the balance sheet rather than being paid out in dividends. So that will be in retained earnings. Then we've got our liabilities. So we can see here that we've got our liabilities and how the liabilities are actually split up. So in this first part, we've got the current liabilities. And again, for Stanley Gibbons, they've got the normal current liabilities that we've discussed. Obviously, for Stanley Gibbons, they've got a reasonable level of stock because they've got all their stamps and their coins and memorabilia and so on that they're selling. So they've got that in their stocks. They've got some people who owe them money. Sometimes collectors have got special rights, so they don't just pay this year, they pay over a period of years because they might be buying a stamp that's very expensive, and because of that they get special terms so that they'll buy the stamp, perhaps even done at auction. And then we've got some cash. The one thing that Stanley Gibbons has tended to be is quite a cash-rich company. It tends to have good profits each year, and these profits have tended to be in the form of cash after a year or two. So profits take a while before they turn into cash, because you've got to get your money back from the people that owe you money, so the people who've bought the items. But for Stanley Gibbons, they tend to be quite good at converting that. So because of that, you tend to find that for Stanley Gibbons, they've got quite a lot of cash on their balance sheet. Sadly, this particular year we're looking at, Stanley Gibbons made a purchase, quite a large purchase of another business, and because of that, their overall financial position has changed a little because of that. And it's quite interesting to compare the two figures, as you'll see here. The next area that we're looking at then are the longer term type liabilities, and again Stanley Gibbons have actually changed this in this last year, but this is fairly typical of what you get. Often you will actually find there's taxation in there, as in this case, and the taxation is because the tax has been agreed but won't be paid for a future period, and it's because of the tax laws and how that actually works. And finally in Stanley Gibbons, they've got their equity. Now you find in a lot of companies that the equity is actually above the current liabilities. So they move this whole section up there and they show, a bit like the accounting equation, equity, then liabilities. So the top of the financial position, where you've got the assets split into the non-current and the current, equals the equity plus the liabilities. So just like our accounting equation that we looked at earlier on. So it's quite helpful to let you see how the whole thing works in practice. Okay, well again I've got the same references for you, and hopefully you can find Stanley Gibbons accounts and have a look at them yourself and see if there are any questions that you then have. Hopefully they'll then be answered in future slides. Thank you.